This is Jeremy Hauser, host of the Advisor Mentorship Podcast. You will not want to miss out on this episode as we have Tom Rozman, who is the Chief Investment Officer of Simplicity Wealth, who's going to talk all things of 2025 with this volatile market, all the strategies when it comes to tax harvesting that our advisors are plugging into within Simplicity Wealth to really help drive more alpha for their consumers. Tom also shares a little bit behind Simplicity Wealth and the team that continues to separate our advisors from the competition around resources and marketing. You won't want to miss it. Make sure to tune into this episode and subscribe at the end. You will not want to miss out on Tom's delightful information here. So kick into the episode. Looking forward to bringing this to you.
Systems work. People fail. Welcome to InsureMark's Advisor Mentorship Podcast with Vice President Jeremy Hauser.
Welcome to this week's episode of the Advisor Mentorship Podcast. I am your host, Jeremy Hauser, and a lot of volatility out there in the marketplace. We also have a new administration that's getting nice and settled in, and I wanted to bring an expert on today's show to get his thoughts on where things are going and also things for the listener that could maybe give you a very prosperous 2025. Mr. Tom Rozman. He is the Chief Investment Officer here at Simplicity Wealth. How are we doing today, Tom?
We're doing great, Jeremy. I'm delighted to be here with you and have a conversation about the markets and what to look forward in 2025.
Me as well, and I'm actually very honored for you to take your time. I mean, you are the CIO of Simplicity Wealth. I'm not even sure what our number is of how many assets currently our family has. Do you happen to know that by chance or no?
Yeah, I think right now on the platform, we're approaching about 11 billion in assets under management. So as you can imagine, lots of advisors, comprise that number.
Okay, that's actually, larger than the last time we spoke. We kick things off here. There has been a lot of volatility. I mean, we've had some individual stocks that have taken some huge swings. I know the media always covers individual stocks and then in general, but what is your analysis here right now with the volatile market that we're in today for 2025?
Well, that's a great question, Jeremy. The reality is that we've had two very, very good years in 2023 and 2024, right? I think just over 26% in 2023, right on, 25.02 in 2024. And so, the thing about that, though, is it sets up 2025 in a, I don't want to say unique fashion, but it puts us at stretched valuations, right? So you start thinking about where the S&P 500 is, over the last 30 years in terms of a median. One measure of valuation is the price earnings multiple, and that's around 16 to 17. Well, today we're about 22 times forward-looking earnings. So you've got that as as the kind of the backdrop. And of course, as you already alluded to, with a new administration, well, we've got uncertainty. Markets hate uncertainty. So think about, trade or regulatory, policies that could be coming out of the new administration. And that has implications for GDP, for inflation. And, certainly with a price earnings multiple the way it is right now, there are some significant expectations around earnings. Well, in some cases, people would even say that it's priced for perfection. And so, unfortunately, right, that means you're going to have more reactions to earnings releases. So, disappointing earnings will probably get punished, more harshly. Positive earning surprises, on the other hand, will move up very nicely as well. And so all in all, right, it really creates an environment where you have to almost expect greater volatility and greater return dispersion, which I think really lends itself to active portfolio management.
Yeah, I think you had touched on a lot of good points there. And, when we go back just a handful of years, so you just referenced 2 years recently, over 20% each year. 2022, we were down, I believe, a little over 20 or right at about 20%. So there's been so much volatility, and then a lot of media outlets really talk about the Mag 7. So mega cap tech stocks, especially 15 to 20% in just like a day. We saw that with NVIDIA here just a couple of weeks ago. So are like people's tolerances just higher, and that's just what they need to be, or what's your thoughts on, I mean, is there just a higher tolerance for the consumer nowadays? Is that just what's expected?
Yeah, I mean, that's really insightful, Jeremy. I think you've got a couple of things in play here. So first of all, right, kind of in line with the increasing valuation in the overall market, um,
Hmm.
you do have, along with that, higher market concentration. So if you look at the Mag 7 and maybe add, you know, Broadcom and a couple of other stocks, right? Maybe the top 10 out of the 500 constituents in the S&P 500, you're approaching market cap concentration of almost 39% as of year end for the S&P 500. And
Hmm.
so inevitably, right, that is going to create greater volatility as well in the S&P 500. And like I alluded to earlier, those stocks are priced for perfection. And so, they're going to also be more volatile because you have what we call specific or single stock risk. Um, but as it relates to investor behavior, I think part of that is a situation where, uh, again, it's recency bias, or what you might think of from a behavioral science point as expectations anchoring. And so people have experienced really good returns where buying the dips has proved to be very fruitful. And so
Hmm.
because of that, there's some complacency, I think, with the overall valuation levels of the S&P 500 because, again, right, they've been rewarded by by buying those dips and kind of holding on, and maybe paying less attention to, as they should, to becoming a little more defensive given the uncertainty in the market.
And also, so we were at an event last week or 2 weeks ago, and bumped into one another, which was great. And we were sitting there chatting, and I had one of the newer advisors with our firm. He was with us, introduced you to, and I think one of the things that stood out beyond, obviously, you're just a very smart guy. Um, he actually was saying to me, our our basically where he's currently at in his practice as a RIA, within his business, and most importantly, when chatting with you, it was all about, with these markets, the volatility, and consumers nowadays, how does an advisor just stand out? And then so I just asked you simply, share a story or so, like where can advisors drive some alpha in their business? How does Simplicity Wealth stand out to really just gravitate more towards that particular advisor who's currently doing all of his compliance as an RIA? So what do you remember that story? I mean, within literally 6 to 7 minutes, I was just like, "Oh my God, Tom, that was actually really good." Do you remember that talking to that advisor?
I do, Jeremy, and it really dovetails pretty nicely with what we've been talking about. You have a situation, right, where we've got market cap concentration. It's really in your technology stocks,
Hmm.
any of those stocks that are presumed beneficiaries of this artificial intelligence revolution. And so the good news, right, is that uh, that has rewarded investors quite amply. But the bad news, if you will, is that now they have concentration risk. They have
Yeah.
large unrealized gains because they've held those stocks. Maybe they purchased them, several years ago, and so unwittingly, their portfolios have become less diversified than might be prudent. You also have situations where an advisor runs into, a prospective client. That client may have worked in a certain industry or at a certain company for most of their career. And so they have a very similar situation where they've accumulated stock at that company, and now they have a
Yep.
large unrealized gain. And so one of the things that we've been able to do is help them in a tax sensitive manner, overcome that burden. Being able to diversify that concentrated risk, and maybe even have a different investment objective. So, going from asset accumulation to maybe an income focus. And so, along with that kind of a context, right, or background, then you have this market volatility. And in fact, we notice it more, but even over history, right? If you look at, I want to say the last 30 years at the S&P 500, you see a lot of intra-year volatility. In fact, a full 75% of the S&P 500 stocks or companies, they are down intra-year 5% or more, but only 30% finished the year down 5% or more. And these are very good markets. And so what I think is very applicable is that we can use a service, right, that Simplicity offers called direct indexing. And along with that, systematic tax loss harvesting. So think about direct indexing very simply as being able to own a subset of the common stocks of the S&P 500 rather than just a single ETF.
Sure.
As time passes, some stocks go up, some go down. When the ones that go down, are selling at a loss now, you're able to establish a loss by selling that and then replacing it with a like security. That loss can then be used to offset gains elsewhere in the portfolio. So think about a concentrated position that has a large unrealized gain. You can start to chip away or lessen the burden, all within a tax sensitive manner, because you're now using established tax losses. So, compare that to a single ETF, you really can't do that. So the beauty of direct indexing is not only the fact that you can mimic very closely the performance of the S&P 500 or another target index, but through the systematic tax loss harvesting, you're able to gain, as you said, some alpha, or in this case, what we call a tax alpha, based on the tax savings. And systematically, right, going in, say, every 31 days to do it, that boost to the performance is pretty significant. It's about, recently, the last couple of years, about 3%. So think about 3% on top of the performance you're getting in the overall index. And then we're able to, do that, amongst all other types of investments. So it doesn't have to be just a cash portfolio. So think of it as only a slice of the pie. And so that sophisticated approach is not something that everyone can do. And then you start thinking about cost benefit, right? If I'm an advisor, if I'm their client, I can offer this service where I can match the performance of the index, get this performance boost or tax alpha of say 3%, and the cost is only 10 basis points. Well, that cost benefit is significant. And it really adds a lot to the competitive advantage that an advisor can bring to bear in that relationship.
For those not familiar with North American, they are a 139-year-old employee-owned company specializing in annuities and life insurance. They hold A-plus ratings with AM Best, S&P, and also Fitch. They had a record annuity year in 2024 with just over $7 billion of issued business that was balanced between guaranteed income and accumulation-focused fixed index annuities. In partnership with Annexus, in 2024, the Secure Horizon suite of fixed index annuities was presented with the Deal of the Year Annuities Award by SRP Americas. The award recognizes excellence in annuity products based on performance, customer satisfaction, and sales volume. From an ease of business standpoint, North American has consistently issued in good order cash with app business within 24 to 48 hours via the Firelight eApp platform. And they just announced a first to market capability within the platform, the ability for the client to take a picture of a check and submit it right along with the e-application. That means instant issue on in good order business and commissions paid that much quicker. If you are looking for an employee owned industry leader in the annuity space that gets business issued fast and you paid commissions faster, North American is that company. For more information around North American's competitive advantages, go to www.insuremarkamp.com/Jeremy and click on Learn More. North American, prepare for your financial future. Yeah, I just remember incredible. And actually listening to it again is almost, there's so much that was covered in that quick little 5-6 minute spurt that even hearing it again, there's another thing that I picked up on, the tax alpha part. I didn't even hear that one whenever we were, I don't know if it was just loud where we're at or what. But I just remember the receptiveness from the advisor himself. I mean, I know they wanted to talk more about that, and it's just something that's a little different out there. And also obviously with Simplicity Wealth being just very, just a great entity, a great group to be a part with not only the members like you, Tom, and others, but the fact that y'all look at insurance too, and other, the holistic approach for customers as just how things work together. And I mean, when we're looking more, so we talked a lot about volatility. So for 2025, since you are, I mean, the chief investment officer, so where can people find, steadier returns in 2025, or what are your thoughts around that?
That is a fabulous question, Jeremy, and it really is in the context of this, equity market that is, price for perfection. So,
Mm-hmm.
right now, and I think, we don't have to go back too far to you. I think you alluded to it earlier in 2022, we had like a 1 in 30 year occurrence where the S&P 500 was down about 18%. The aggregate bond index was down about 13%. So both
Double
stocks and
digits.
bonds were had a negative return. That's not normally the case. Normally they kind of offset each other, but we were coming from a point of very, very low interest rates. And then you had an increase in the money supply, an increase in, in fiscal support, right, due to the pandemic that sparked inflation.
Inflation.
Federal Reserve response, rightfully so, was to raise interest rates 11 times and over 5%. The good news, right, is that coming out of that, you now have current yields that are very attractive. They can provide, I'll call it ballast in a portfolio, right, to the equity side of the house. And so current yields have a high correlation to forward-looking returns in the bond market. And so, even going out about 5 years. So with high current yields right now, we're in a situation where you can really look at those, and they're attractive, especially in the municipal bond market. We have local, state government authorities who are issuing bonds for public projects. There's a federal tax exemption. There's also a state tax exemption if you buy an in-state bond where you're living as an investor. And so the tax equivalent yields right now on those are really fantastic. In fact, you look across all the fixed income sectors, I think they're probably the most attractive, especially when you consider the low default rates that you have on investment grade issuers. I think it's less than 1%, historically. So we really like where you are right now with bonds. I'd mention one other thing with regard to bonds. At these current yield levels, there's what's called an asymmetric bond payoff. Now, it's a word salad there, but I think what it means is that you look at say a 5-year treasury. At these current yield levels, right, if interest rates were to go up, so let's say we're wrong about the long-term trend, or at least temporarily, interest rates go up, right? You don't have a punitive kind of a reaction or effect to your return based on the current yields. I think if interest rates went up, a 5-year treasury, you'd only lose like 0.1%. total return. However, if we're correct, and over the next year, right, say, and we're not forecasting a 1% return, probably more like 50 basis points by the Fed in terms of their what they call their dot plot. But a 1% decline in interest rates, well, now you've got close to a 9% total return in something like a 5-year treasury. So that's what we mean by an asymmetric payoff. We think that makes bonds very attractive.
Yeah. Wow. So that's something that I know in a lot on taxes though. So I want to kind of talk about that a little bit more because I think a lot of the competitive advantage for those advisors that have moved forward with Simplicity Wealth. Talk a little bit about y'all's team. I mean, for having the conversation, because everybody wants to know from seminars to webinars when advisors are marketing to want to bring new prospects in. People want to know how they can get an edge on taxes. So I know the handful of people that have already started to work with you guys. So everything you've mentioned so far, it seems like it really has a tax basis around what y'all's philosophies are. Is that a fair statement?
Yeah, I think that's fair. When you start looking at taxes at some point, right? Um, it's always been a little bit ironic that um, you know people are a little bit averse to paying taxes even when they are able to make significant gains in the equity market. But again, referring back to direct indexing and tax loss harvesting, that's a really fantastic way to be able to garner growth, to accumulate assets. Simplicity, I think, is rightfully at the intersection of accumulation and protection.
Yep.
So on the accumulation side, right, lots of opportunities there around direct indexing and tax loss harvesting, around municipal bonds, and then of course, Jeremy, you would probably know this better than anyone, around the ability to have tax deferred growth, say in qualified accounts or in a Roth account where you can get tax free growth. That's really a fantastic vehicle for accumulating assets. And then also some very sophisticated approaches around insurance and annuities to, again, be able to either defer taxes or have tax-free growth.
And so I know we talked a lot about bonds. We talked about fixed income options out there for advisors to consider amongst the group. So as a chief investment officer, how have you seen fixed index annuities play a part within the holistic approach for advisors that are working with us at Simplicity Wealth?
Well, I think it's helpful to have a little bit of a historical context on this. So if you go back, um, you know, for sure to the 60s or the 70s, by the 80s, it was starting to taper off. And what I'm talking about is defined benefit pension plans. So, there was a desire, right, with greater career mobility to be able to have a qualified account that was portable. And so think about the introduction of contributory accounts like a 401k. However, that was at the demise, right, of having a pension where, back in the day, a lot of people would stay at the same company because of that pension benefit. And the fruits of that were income certainty, right? That could be counted upon along with other sources of income to be able to, support an investor, in retirement. And so, when I think about a fixed indexed annuity, number one, you said it. We look at that as an asset class, no different than stocks and bonds. We do take a very holistic approach in terms of how that annuity then fits into the overall portfolio picture. How does it address, the financial planning considerations that impact everyone from the ages of 25 to 95? But the great thing about a fixed indexed annuity is that it can be viewed rightfully as a replacement for what would have been, a pension benefit that people would have had in previous careers.
For those not familiar with North American, they are a 139-year-old employee-owned company specializing in annuities and life insurance. They hold A-plus ratings with AM Best, S&P, and also Fitch. They had a record annuity year in 2024 with just over $7 billion of issued business that was balanced between guaranteed income and accumulation-focused fixed index annuities. In partnership with Annexus, in 2024, the Secure Horizon suite of fixed index annuities was presented with the Deal of the Year Annuities Award by SRP Americas. The award recognizes excellence in annuity products based on performance, customer satisfaction, and sales volume. From an ease of business standpoint, North American has consistently issued in good order cash with app business within 24 to 48 hours via the Firelight eApp platform. And they just announced a first to market capability within the platform, the ability for the client to take a picture of a check and submit it right along with the e application. That means instant issue on in good order business and commissions paid that much quicker. If you are looking for an employee owned industry leader in the annuity space that gets business issued fast and you paid commissions faster, North American is that company. For more information around North American's competitive advantages, go to www.insuremarkamp.com/Jeremy and click on Learn More. North American, prepare for your financial future. And I mean, still, every study we see, I mean, there's surveys consistently throughout the years. I mean, ever since I've been doing this as well, it seems, at least for 10 years, the number one concern with people that are retiring is the fear of outliving their money. And so, to what you're saying too, is it is almost like a perfect storm that hopefully advisors that are now, even advisors in the 90s and coming into 2000s, that really viewed annuities only on the income side of the equation for their solutions for consumers. I think more advisors nowadays that we maybe come across, if they're new to simplicity in general, some of them are actually now viewing these annuities for the strength of guaranteed income, but also just downside protection, as
Great
well too.
point, Jeremy. I mean, when I think about the benefits of a fixed indexed annuity, it certainly is around that income certainty. But you make a good point, and that is it's a great offset to market volatility, which we've been talking about,
Mm-hmm.
for the better part of a half an hour. So you've got, a number of different benefits. And of course, you already hit one of the major concerns of investors, which is, longevity. Great medical care. We're all living longer. In fact, it's funny. My mother's 97. And when I ask her, she never thought that she would be alive at 97, and to see, great grandchildren. And so it's a very real concern that fixed indexed annuity, that solution certainly solves for that problem.
Are you an advisor currently working in your business instead of on your business each and every day? You are not alone. We come across advisors every single day that are constantly asking us, what can I do to get better? How can I go from being an advisor to a CEO? How do I delegate? If you find yourself asking you these same type of questions in your business to your team, you're in the right place. Make sure to check out our resources here at www.insuremarkamp.com/Jeremy. You can hear from successful entrepreneurial advisors like yourself as they have plugged into our systems and processes and continued to scale their business. If you are an advisor that's looking to go from advisor to CEO, make sure to go to www.insuremarkamp.com/Jeremy. Click on the Learn More section, insert your information. We'd love to get our introduction kit to you. Now, back to this episode. Mm-hmm. No, and that's also, even though, I see some studies nowadays that people aren't living as long as they used to, but it seems like every year it flip flops. But I think, yeah, to your point, I definitely see where, and to what you've mentioned, obviously, over the last half hour here, the interest rate environment we're in. So uncertainty too. So the Fed didn't announce any rate changes here recently, but it's good to have all solutions inside of the holistic approach though within y'all's team. So if for an advisor, let's say they've stuck around, they listen to us, and maybe they don't know the full Simplicity story for Simplicity Wealth, or perhaps they maybe have heard it over the years. Can you talk to that particular individual where what's some of the advantages outside of what you've already articulated around the tax harvesting and some of the strategies that Simplicity Wealth's doing? Why would someone consider looking at wealth if they are looking for a new home?
That's an interesting question, Jeremy. And I feel like in some ways, I don't want to say uniquely qualified to answer that, but certainly I approach it from the standpoint of almost being in this industry now for 40 years. And 14 of those were as an advisor. And so when I sit there, and we've talked a lot about, you know, products,
Mm-hmm.
solutions, in the context of the market. But I really think about what Simplicity can do to help advisors. It's really around practice management, and so foundationally, I think everyone would agree that you really want to be able to manage client expectations and set them up for success. And so one of the things that we've developed as part of the overall offer at Simplicity Wealth is a very novel risk scoring methodology. It's based on the value at risk concept, was pioneered by JP Morgan back in the 70s. However, we used it in a kind of unique way where we're looking to quantify the client's feelings around the potential loss outcome, both in terms of the magnitude of loss, but also the speed of loss, or what we would call the experience of loss, because we believe that is really relevant. 20% loss experienced over 12 months is certainly different than 20% over 3 months, or if you harken back to Black Monday in 1987, it was 20.4% in one day on the
Mm-hmm.
S&P 500. So, I like to think of it, you know, one versus another, right? You could be skiing down an intermediate blue run, and that might be a little harrowing but manageable, right? Skiing down a double black diamond or off a cliff, probably not so much. And so we think that downside risk first approach really works well to try to mitigate some known financial biases that investors have. Overconfidence, expectations anchoring, framing, how you ask questions. We really want to make sure that they're comfortable with that loss. And what we do is we help them self-calibrate their feelings on it, because we know that potentially, if they're self-calibrating their exit point, that's where they're at the greatest risk of capitulation or getting out of the market. We don't want to do that, or help. We want to help them stay the course, right? We don't want them to get out of the market, because we know that time in the market is a higher probability of a positive outcome. So think about the power of that, and then integrated with that is a very innovative portfolio monitoring and communication tool set called Asset Lock. Now, our
Mm-hmm.
head of sales, Jason Jenkins. I know that you know him as well, Jeremy. Everybody knows Jason. He does such a marvelous job in the practice management area and around our advanced sales training. But when he was an advisor, and need is the what do they call that, the genesis of invention, right? Or he developed for his own practice an ability to have relevant, timely communication that
Sure.
was scalable and personalized. And so now Simplicity Wealth has Asset Lock as one of the proprietary tool sets. And the power of that alone is certainly significant. But when you combine that with the value at risk scoring methodology, now you've got something that is really significant in terms of keeping kind of the promises that you made as an advisor to all of those clients. So I can't say enough about foundationally how those tool sets really set an advisor apart from the competition.
Yeah, and to that point too. So communication is something from just anybody, as most people who listen to the show are advisors, that's the one thing that there was a study, it was probably 2023, that over 70% of customers, so coming out of 2022, so over 70% of consumers were actually going for a second opinion or leaving their advisor. So, and one of the biggest issues that we found in the study had to do around just strictly communication. So when times are tough, they just want to have some form of communication. So I think that is a good bridge to or a competitive advantage as an advisor, to have something that you can't talk to every single consumer or every one of your customers in one day, especially if you have hundreds of even thousands of people. So it's good to leverage tech in that essence. And then two, from what I'm hearing, is more on the delegation side. I mean, a team like you mentioned earlier, so 11 billion is not small. That's a lot of assets under management. And I think whenever I have an advisor who speaks to Simplicity Wealth, you guys have at least, it's not just one person they're talking to. They got at least 4, 5, 6 people just within the first 60 days. So you really do have a team that's inside of there. And that's what I think the consumer nowadays is looking for, is someone who has a team behind them. So if something happens to the advisor, there's someone there. And number two is communication. So very strong points for, yeah.
Yeah, I mean, what's good for the investor or the client is good for the advisor. And so you mentioned support and dedicated teams. Well, besides the investment team that I manage, right, there are host of other kind of departments within Simplicity Wealth that are really dedicated to making sure that advisor gets the support they need, because ultimately the client doesn't really care too much about who does the performance reporting or the billing or things of that nature, right?
Mm-hmm.
And so what we do is take that burden off of the plate of the advisor and allow them to grow their business.
Correct.
And in fact, Simplicity does some other things that I think are very unique in terms of not only reinvesting in the platform to make doing and growing business easier, but also, for those advisors that are affiliated with Simplicity Wealth, there's an opportunity for Simplicity to invest in the marketing efforts of that advisor to help them grow their business. So those incentives around lead generation, marketing campaigns, support of webinars with compliance approved, content around Social Security and retirement principles. Those are fantastic. Get incredible response rates. And again, right, it's all about helping the advisor grow their business.
And I can't, yeah, and you can't shy away the training aspect too, because advisors at the end of the day, they don't. Paperwork's not their strongest asset. It's being in front of people, and so possibly hiring individuals to help out with paperwork and getting the money in motion and so forth. But y'all's team literally goes above and beyond to train those individuals. So no, can't say enough things. So I appreciate you coming on. Is there anything we missed as we're wrapping up here, or words of wisdom from the historian, Tom
Well,
Rozman?
I think we covered a lot of ground for sure. I think when you start thinking about setting clients up for success and some of the tools within the overall Simplicity Wealth offer, you definitely need to lean in. Make sure you're utilizing those tools, right? Because they're only going to help you, and importantly, right, they're going to help you gain insight and ensure, right, that your clients can stay committed to their financial plan.
Good stuff. Well, thank you once again, Tom, for your time today. Thank you very much to also the listener for tuning in. Make sure to subscribe to the Advisor Mentorship Podcast so you do not miss out on any future episodes. And make sure to connect with us on LinkedIn at Jeremy Hauser and subscribe to our YouTube channel at Jeremy Hauser AMP. And as you share this episode with a colleague or a friend, just remember, in a world full of betas, be an alpha.